Real estate is back. My favorite real estate investment trust of all time, Riocan, is printing tendies today, guys. They posted earnings, they increased the dividend, and damn, it's finally nice to see some life coming back into that beast that just got slaughtered through March of 2020. We're going to be talking about that today. We're going to talk briefly about TELUS Communications, which also posted earnings. That is the only other green stock in my portfolio today because, of course, it crushed. And then we're also going to talk about some alternative REITs that I'm looking at averaging into as we kind of discuss the overweighted position that Riocan is in my portfolio. If that is a conversation you appreciate, of course, consider hitting that like button. I'd really appreciate it. But first and foremost, guys, take a look at the position. It is the largest position in my portfolio. I own 1,070 shares of Riocan at an average price of $17 a share, currently worth $25,000. Since we've been buying it back in that March 2020 crash, guys, we're up 37.56%. Tap on the 5% yield I got at that price over the last 2 years, and we are by no means complaining about the return. But let's take a look, guys. Why do I love Riocan? Riocan gives me the exposure to by far the absolute best real estate, in my opinion, that Toronto has to offer. This one piece of property right here that is now 83% complete, looking to come online toward the end of this year, early 2023, that is 90% leased already, is the future of what Riocan and these large construction and real estate investment trusts see for the future of Toronto, which is basically these mixed use urban centers where you have massive malls at the bottom, basically residential condo units on top, and a little bit of office space in between. So you're basically living in a city that is built up to the sky. This is probably going to be one of the most premier buildings in Toronto, right on Front Street, literally just walking distance from the CN Tower. I honestly think this has the potential to be like $1 billion real estate property in and of itself, but it's only just the start here, guys. So let's get into this with obviously the best news, the dividend coming back, because they did cut it moving into 2021 down to 88 cents annually, which gets divided out and paid monthly. But they just announced on the earnings call that they are raising it up to, I think, $1.02. It's about a 6% increase. We're nowhere near back to the $1.44, but with the shares I currently have, it bumps the dividend annual yield up by 80 to $100. So by no means complaining there. Let's talk about the earnings themselves. Let me kind of scale my head out of the way here, guys, because taking a look in March, or just basically through 2020, they did 1.14 billion in sales against 1.32 billion in 2019, and we haven't exactly recovered from that, in my opinion, because the total revenue was only 1.175. It is definitely stabilized and heading in the right direction, but this is by no means kind of just clean cut its way out of what the pandemic did to them. But I believe they're heading into a good direction, which is what we're going to be discussing here, because I'm purely holding this for cash flow. They're back to like 98% rental collection, very much stabilized some of the issues that they had through the pandemic. So what I'm really pleased by is that we should start seeing increases in adjusted funds from operation, which is what they're basing the dividend increase off of. They said for as long as the funds from operation continue to go up, they don't see why they're not going to keep increasing the dividend, perhaps doing some share buybacks. And it looks like we can get some growth also just from the average net rent, looking like it's increased through 2021, likely increasing again in 2022 with the hot real estate market that Toronto is, being primarily the hottest real estate market in the world right now, against a few other exceptions globally. But take a look, guys, because their tenant basis is arguably more diversified than other similar REITs like Smart Centers that we're going to talk about, because no one tenant makes up more than 5% of their total portfolio, but at least 20% of their total rent right now is collected from things like Costco, Walmart, Loblaws, Shoppers, Rexall, LCBO, Metro, Sobeys, like an incredible tenant list that is now stabilizing as they start removing those kind of apparel and those lower end, retail mall companies that just couldn't survive the pandemic. And that's why we're not seeing full revenue growth back, because they obviously cut those tenants, cut the worst properties, and are trying to restabilize and focus on the future and where they see the most stability, which is what we're going to be talking about right now. Because I've mentioned this a lot when it comes to Canadian companies, that Canada's population is forecasted to grow 1% by 2025 on a compounded basis, surpassing other G7 countries' growth. And this is due to a lot of immigration, the fact that we're a lot smaller of a country, and this is continuing to bode well for basically any staple to the Canadian economy, because we're not like the US. There's not dozens of companies competing. There's a fairly small amount of large real estate investment trusts, telecom companies, banks. That's why I love the Canadian sector so much, and it's starting to prove out in these upcoming earnings that we'll be discussing. But the housing demand is outstripping supply in major markets, particularly Toronto and Vancouver, and Riocan is trying to fix these with these massive new mixed development properties. So let's just scroll through this real quick, because they got 43.1 million square feet embedded development pipeline, which is astronomical, guys. As I mentioned over the last several years they've been trying to pivot away from malls and start really building out these fundamental kind of like cities in the sky. And let's just take a look here, guys. I want to scroll down and just kind of point out some more of the highlights that I think are prevalent here. Obviously, we can take a look at some of the buildings, but where is the data? First and foremost, I like the fact that we're going to be getting through 2022 and 2023, 750 square feet coming online consistently year over year, which should bode well for the continued revenue, as most of these are completely leased out already, which is what I love. And then on top of that, guys, we're going to be seeing the Well come online, which is, again, probably arguably one of the most premier properties you could own in Toronto, in my humble opinion. But when we take a look at some of the major properties, like I went and looked at this one, the condominiums at 11 Yorkville, this property is still just getting warmed up. I mean, when I went and looked, it was still a hole in the ground, but it's in one of the most expensive parts of Toronto, and I'm blown away that it's 99% sold, with 586 units ready to come online between 2024 and 2025. But everything else, guys, I remember when I was looking at this last time that we started seeing the sales kind of finalize up, but it looks like most of them are now completely sold out across the entire board. So I mean, by no means complaint looking at the pipeline of residential that they're shifting into. So very happy with the general remarks that I heard from the conference call. So let me just pivot a little bit and let's talk about TELUS Corp. Maybe I'll shrink my head so you guys can see the position. Now, I did buy a lot of this. I think I bought another $6,000 or $7,000 worth in my TFSA a couple weeks back before earnings came into play here. And TELUS has been nothing short of an incredible telecom company with a diversified growth sector focused in telehealth. It's kind of like Teladoc, but you get this fundamental. This is what I love about some of these big conglomerates. This is why I have like a kind of a really fixated idea on things like Tesla and Facebook, because you're getting this really fundamental business that continues to grow while they also invest into these new upcoming sectors that are completely diversified away from their primary business. But again, they posted earnings, guys, absolutely crushed it, hitting all-time highs today. No complaints. And just take a look, because I'm going to show you how this relates to Riocan. But first and foremost, guys, they saw operation revenues increase 20%, largely driven by what I'm going to call the population growth, because as population grows with only a few of telecom companies to go to, it's no surprise that literally quarter over quarter, they've seen nothing but growth. And when we're talking about cell phone, internet service, security services, and telehealth, it's no surprise that these people don't lose people, right? I mean, when you get a phone, guys, you kind of get locked into a service and you don't really, you're not really implied to change that anytime soon. So I really love what's going on with these two companies right now, but in a heartbeat, I have been going through a risk adjustment in my portfolio because, like I said, guys, I am just getting ready to move my living situation. My expenses are going up. I'm looking at capitalizing on an emergency fund, which I just opened a GIC account for to get a higher interest rate of return on that. And I just want to stabilize my portfolio and readjust my risk tolerance, which is going to lead me to actually scaling down Riocan, not by much, maybe by about 20% or so, maybe $5,000, $6,000, something like that. And I've been looking to pivot it into some other cash flowing REITs. I've been looking at things like Dream Industrial. I've been really analyzing smart centers because I really feel like these two companies are almost exactly the same to varying degrees. The only difference is I think Riocan has a more stabilized balance sheet because their payout ratio is a lot lower and they're giving themselves room to continue to increase it. Obviously, it sucked if you're holding it before they did the dividend cut, but for many of us that were buying the dip, I mean, if your opportunity started at that $15 to $17 range, it's really just blue sky ahead. Now, this is one I haven't bought into, but the yield is much higher at 6% over Riocan's 4.5%. But again, guys, the payout ratio is a lot higher, so I need to listen to the earnings call when this company comes up, I think February 15th, just to get a feel out along with Dream Industrial, a few other ones that I'm looking at, and I'll maybe pivot into one of those once I feel a little bit more comfortable. The dividends were never cut on smart centers. This one, unlike Riocan, is also largely encored by Walmart. I think Walmart makes up 20 to 25% of their total rental collection, but even still 60% of the rents are strong credit worthy. Same sort of deal with Riocan, McDonald's, LCBO. I mean, a lot of the banks as well, the telecom companies. So there's no really big complaints from the diversification. But what I find most intriguing about this, whereas Riocan seems more focused on these massive, high valued properties in Toronto, this one, however, is kind of these open-ended malls that you'd see kind of on the outskirts of the city. Like, I don't know if you know, guys, like Newmarket or if you know, like Stouffville. And what they're doing is they're pretty much building small cities around these shopping centers. And this is largely driven by like government incentives as well, as the government's trying to compete and solve the problem of the supply and demand issue in the real estate market. So when I kind of scroll through, take a look at this one project here, guys, 20 plus million square feet that they want to bring online. Like, astronomical builds. So this one's kind of taking a different vantage point than Riocan is, but I can see the value in buying a piece of this and just diversifying my REIT income exposure, because like I said, guys, you don't know what you don't know. Riocan's great. I love it. But at the same time, if you just bought Smart Centers, you wouldn't have gone through a dividend cut, and the company's been still stabilized and doing relatively okay. But I want to listen to earnings. Buying individual stocks come with a lot of risk. And you want to pay attention, guys, to exactly what's going on, get a feel out for management, and just make sure you're not throwing capital, hopefully, into a burning fire, because there's no guarantees, and Facebook slapped me upside the head. But God, look at the size of these properties, man. I mean, unbelievable, the projects that are underway. So this is one that I'm definitely going to be eyeballing here and paying close attention to. But I really, really am happy with the Canadian economy, because it's really stabilizing the volatility of my U.S. stocks right now. And I passed the question off to you. How did you guys take the Riocan earnings? I know a lot of you are big fans. What other REITs are you buying as well? Many of you know I'm a big fan of things like MPW, Medical Properties Trust, one of my favorites, along with Stag Industrial. And then the only other REIT I currently own is Riocan. So at this point, folks, let me know what you think, but stay cool, stay awesome. And as always, I look forward to catching you in the next one.